Have you heard the saying, seeing is believing? Well, I actually live by that statement. I mean, how can a retirement portfolio that includes a fixed annuity at a very low interest rate outperform a retirement portfolio that's diversified between stocks and bonds? Especially when the annualized return over the last 20 years for a portfolio of bonds, which includes your U.S. corporate, international, and even your riskier high yield, would be 5%. The 10-year Treasury note back in 2000, the interest rate was 6.7%. Do you know what that rate is in 2020? It's actually less than 1%. So why do I mention bonds? Because I actually replaced the bonds from a retirement portfolio with a deferred income annuity, again, at a very low interest rate environment, and kept the equities in the portfolio as is. So does the saying, the more risk, the more reward, stack up for a retirement portfolio that includes a fixed annuity that carries no market risk and a very low interest rate? So let's see what happens. Hi, my name is Darlene Hartman, and I'm a CPA and founder of D. Hartman Consulting, LLC. For the best retirement annuity advice, subscribe to my YouTube channel and hit that notification bell so that you can receive notices anytime I post a new video. Before I share the results with you, I wanted to set the scene for you. So I assumed that you have a $1 million retirement portfolio and that you retire at the age of 65 on January 1st, 2000. You are going to withdraw 5% or $50,000 from your retirement portfolio on an annual basis. So the first portfolio, which is actually going to be represented by the orange line in the graph that I'm about to show you, consists of a diversified portfolio between stocks and bonds. So you are subjected to 95% market risk with this retirement portfolio. The portfolio consists of large cap, mid cap, small cap, and international stocks, in addition to your U.S. corporate, international, and high yield bonds. Now the second portfolio, which is going to be represented by the blue line on the graph, actually includes a deferred income annuity for 35% of your retirement portfolio, which means that 60% is now subject to market risk and 35% is not. Now, with respect to that deferred income annuity, it is cooked for 15 years, and you start receiving those guaranteed income paychecks on January 1st, 2000. Now, keep in mind, I used a deferred income annuity at today's interest rates and not the interest rates back in the 1980s. And if you remember the 1980s, the interest rates were pretty high, especially compared to today. No costs were factored into this analysis. That would include commissions or management fees or even taxes. And the inclusion of these costs and taxes could have a significant impact to the results that I'm about to present to you. Leave me a comment in the section below and let me know if you believe that the more risk, the better the returns for your retirement portfolio. Also, if you're enjoying this video, be sure to give me a thumbs up, subscribe to my YouTube channel, and hit the notification bell so that you can receive notices anytime I post a new video. Well, the title gives it away. Including guaranteed income for life in your retirement portfolio not only results in a $500,000 higher ending balance for your retirement portfolio, but also improves the annualized return on your retirement portfolio by 1.6%. So you may be asking, how is it that I replaced 35% market risk, which was varying levels of low and high risk, with a 35% no market risk product with a super low interest rate and end up in a much better position than with a fully diversified portfolio of stocks and bonds? Of note, I think I just proved why the statement, the more risk, the more reward, is not true with respect to a retirement annuity. Now let me explain why. You can't tell from this graph, but the guaranteed income you receive monthly from the deferred income annuity represents 60% of the $50,000 you withdraw from your retirement portfolio annually. So 35% of your retirement portfolio is generating 60% of your annual cash flow. Pretty sweet, right? Besides the obvious, what does that mean as it pertains to the performance of your retirement portfolio? If 60% or approximately $30,000 is being withdrawn from your retirement portfolio from the deferred income annuity, then that means you need to sell less stocks to cover the difference of around $20,000. So why does this matter? Do you remember me talking about sequence of return risk and how sequence of returns matter if right before retirement or if you're early on in retirement? So at the time of retirement, if we're in the midst of a market downturns, that's going to mean that you're going to have to sell even more stocks to ensure that you have enough money withdrawn from your retirement portfolio to cover your cost of living expenses for that year. As you can see, a double negative can have a pretty significant impact on your retirement portfolio. And if you encounter more than 1 year of market downturns, as happened in 2000, where we had 3 consecutive years of market downturns, that can take a pretty big bite out of your retirement portfolio. With less risk and therefore less pressure on your retirement portfolio with the inclusion of a deferred income annuity, you can now be a little more aggressive, if not riskier, with your equity investments in your retirement portfolio, because you know you have that guaranteed income coming to you every month for the rest of your life to cover your basic living expenses. And what about the withdrawal rate? So historically, a safe withdrawal rate has been 4% from a diversified retirement portfolio to ensure that you do not outlive your money. So if you have a fixed annuity, such as a deferred income annuity in your retirement portfolio, and you're insured to get that guaranteed income paycheck to cover your basic living expenses for the remainder of your life, then maybe you have a little more flexibility with respect to that withdrawal rate. And maybe you don't have to withdraw the same percentage year after year. Are you starting to see a more secure and happier retirement for yourself? And let's not forget about those invaluable mortality credits. You remember that the value of a retirement annuity is those mortality credits, and that you're not having to pay anything extra for those mortality credits. So you're getting more reward with no risk. So are annuities good investments? So you remember me saying that annuities are not investments, especially given that we are at historically low interest rate environment, but rather contractual guarantees provided by an insurance company. The question is whether you can afford to be without those guaranteed income benefits that a retirement annuity can provide your retirement portfolio. Are you starting to see how a retirement annuity could benefit you, even if you're not a conservative investor? Every retiree could benefit from a portion of their retirement portfolio being allocated to a retirement annuity. And now you see how productive a retirement annuity in a retirement portfolio can be. Need I say it? Mortality credits. If you're wanting to ensure that you have enough guaranteed lifetime income in your retirement portfolio to cover your basic living expenses to ensure that you cannot outlive your money in retirement, be sure to click the link below to apply to become my client. Also, be sure to like this video, subscribe to my channel, and hit the notification bell so that you can receive notices anytime I share a new video. Also, be sure to share with your family and friends. Thank you for watching. Let's get the conversation started on how you can live your best retirement while not outliving your money.